Well, we live in the age of information every day and we are bombarded with news and data. CNBC TV 18's Clutter Breakers will cut through the noise, help you make sense of the news with in-depth analysis. This is your guide to navigating the uncertain environment as we attempt to help you make smart investment choices. Before we begin, let me make it clear that these are not stock recommendations. The idea is to turn the spotlight on interesting developments and trends so that you, the viewer, get actionable information to make informed decisions. Now, the first half of FY21 is done and dusted, 6 months that have left a lasting impression on all of our minds as India was gripped by the COVID-19 pandemic. But on the Lal Street, it was a different story. The Nifty has rallied a whopping 31%, but how does it compare with the rest of the world? And what were the big drivers on D Street? Mangla Malu is here with the wrap of the first 6 months of this financial year.
Well, as we move to the midway of FY21, important to look back and analyze the performance of the markets in the first semester of this fiscal year. Well, for starters, it's been a 31% rally that we've seen on the Nifty. But of course, it comes on the back of a very low base. FY20 saw a 26% decline due to the COVID-led fears in the market. Thereafter, we've seen this big rally. Now, there are a few things we need to understand about this rally. First up, most stocks at the start of FY21 or the end of FY20 were at 52-week lows. We saw a big decline in the month of March on account of lockdown and COVID-related pandemic. And after that, we saw a big rally in the global markets led by the Nasdaq, largest of all the central banks. And at the same time, in most cases, attractive valuations. They'd been beaten down to pulp. So a lot of people perhaps looked at that as an opportunity to go ahead and buy some stocks. The big impact came in from Reliance. After the big fundraising that we saw for both Jio and now retail, Reliance actually contributed 800 points to the 2,600 point Nifty rally. So global markets, liquidity, Reliance, valuations, as well as a low base, all these favored the rally that we saw. Talking about the rally itself, global markets, Nasdaq has actually been the mother of this rally, 45% gains. Nifty follows with 31%, the other indices between 23 to 28 odd percent. Even if you look at the emerging market pack, barring the Korean index, which is up 33%, it's the Nifty which is the leader all the way. Shanghai, Brazil, as well as Hang Seng, all of them follow. Hang Seng's actually been an underperformer. For the Nifty itself, we've been talking about how IT and pharma are the leaders of the new rally. Well, surprise, surprise, it's the auto stock which has actually done the best performance in the last 6 months. 67% growth out there, and that's on account of a handful of factors. Personal mobility, hopes of personal mobility increasing, and strong performance of rural facing auto companies or tractor companies as well is what led the auto rally. The Nifty Bank, however, has been the one conspicuous by its absence in this rally, just 12% higher. That's been the big underperformer in the last 6 months. Mid-cap index, of course, putting behind it a 45% rally. Let's look at the top Nifty gainers. Then 114% gain on M&M. Reliance, the big boy out there, adding nearly $100 billion to its market cap in the last 6 months. JSW Steel and HCL Tech putting a good fight as well. Among the losers, we have far and few in between. Among 8 or 9 Nifty stocks which are in the red in the last 6 months, surprisingly, we have HUL and Bharti Airtel, which were the stars of FY20, seeing a red tick in the first 6 months of FY21 as well. But the real stars have been the mid-cap index, saving itself from the brink of bankruptcy. Vodafone Idea gained about 207 odd percent. Big gains coming in for some pharmaceutical stocks as well. GSPL and Tata Elxsi doing well too. Among the losers in the F&O space, we had a whole host of these PSU units. We have Bank of Baroda, Union Bank, PNB. From the PSU space, HPCL not doing too well. And from the financial end of things, Shriram Transport also ending on the losing side. The big money was made in small caps this time around. In the last 6 months, there have been multiple stocks which have gained 100, 200 and 300%. These 5 of them have been among the top gainers. We've had Aarti Drugs 515%, CG Power 375%, a new owner coming in out there. Mastech and Balaji Mines putting behind them 200 and 350% sort of rallies in just the last 6 months. That's about the last 6 months. Valuations not particularly cheap now. All eyes will be on recovery in the next 6 months, and let's see where we go from here. The first half of FY21 goes to the bulls.
First half done and dusted. Mangla, many thanks for joining us. Now, stocks were not the only asset class that rallied. Commodities have also seen a big up move as many investors chose to diversify their portfolios and actively scout for safe haven assets. Manisha is standing by with a primer on commodities and the best options to invest: gold and crude.
As an investor, you need all kinds of asset classes in your portfolio, short-term and long-term. After all, the idea is to make profits. Commodities are firmly back in vogue as the coronavirus pandemic led investors into safe havens. Tangible commodities and food have seen renewed interest. We bring to you all that you need to know on how to trade commodities and how the sector might fit into your portfolio. In India, trading in commodities makes sense for various stakeholders as nearly 58% of industry is directly or indirectly related to commodities, apart from the agriculture sector. So what is a commodity? Commodity is what you eat, wear, the transport you drive, the fuel you put in, wood, jute, etc. A commodity can be mined like metals, it can be produced like energy, it can be grown like agriculture and plantation. In India, you can trade all of these commodities, while globally, commodity exchanges also trade orange juice, cattle, pig futures, even weather futures. Commodities in India are traded on all the 4 exchange platforms, MCX, NCDEX, BSE and NSE. And you have a wide variety of products to choose from, futures and the recently launched indices. So while commodity is a part of your day-to-day life, when it comes to investing or hedging into commodities, there still are some myths there. Remember, commodity trade can be used by all stakeholders, namely the producers, traders and consumers like me and you. The next big question is, why should you trade or invest in commodities? You should, as it provides a diversification in your portfolio. Commodities are a great hedge to inflation. As recent times have shown, more stimulus leads to higher prices in tangible commodities. And since commodities are globally traded, this can be your way of having a piece in the global linkage. The world over, commodities are bigger markets in size and volume than equities. The difference between trading commodities and equities is that commodities trade is cyclical, short-term, and the focus is on hedging or making profit through price change. You rarely own commodities, while in equities usually are long-term, focus is on ownership of a firm. The top 5 traded commodities in the world are crude, steel, and copper. Gold is at a number 7, but in the Indian markets, gold is a top traded commodity, followed by crude and then copper. In agri-commodities, the ranking is oilseeds, pulses and guar. If you are new to commodity trading, start with something that you are familiar with, like gold. Start with a gold mini 100 grams contract. So if the price of gold per gram is 5,000, then for the 100 gram contract, it would be 5 lakh rupees. But commodities are highly leveraged products. So at a 8% of an initial margin, you can trade that 5 lakhs with just 40,000 rupees. Buy one gold mini contract. Gold has been moving nearly 2 to 3% on a daily basis. So if the price is again by nearly 150 rupees per gram, you stand to gain 15,000 rupees for that one contract. But remember, gold is a compulsory delivery contract. So if you don't want to take the delivery, you have to wind up the positions 5 days in advance, or you would be marked for delivery, where you would then need to pay the full 100 grams amount and you get a physical delivery of a 100-gram gold bar. You can also follow similar steps for a trading position in crude oil, but just remember that the initial margin here is 10% and you will not get a barrel of oil delivered to you when the contract expires. So whether you want to buy gold as a financial product or hedge your portfolio, petrol, diesel, currency moves with the crude, you can do it with commodities, and that too with a high leverage.
Manisha, thanks very much. No gold bar or barrel of oil for me. But speaking of commodities, the government has slashed domestic gas prices by 25%. While it is positive for consumers of gas, it is a blow for gas producers. So how is the price of gas fixed in different countries? What will be the impact if the price cut is not passed on to the consumer? Sonal Bhutra is here to explain.
Well, a 25% cut in domestic gas prices, lowest since the new domestic gas policy was introduced. So let's take a check on how these prices are actually calculated and which all sectors are impacted. Well, there are 2 types of gas pricing mechanism. One is APM, administered pricing mechanism. The other one is non-APM. This specifically is for specific fields, is usually higher than the APM gas, but it is APM gas pricing which is more conventional and widely used. So let's see how these prices are really calculated. Well, these are market linked to the markets in US, UK, Canada and Russia, and it is reset every 6 months. It is a weighted average of volumes and pricing at these 4 hubs, which with US with the highest weightage in this particular segment and Canada with the lowest at 7%. But if we look at the trends, it has been calculated at the lowest levels in second half of FY21 at $1.79 per unit, and it started with $5 per MMBTU. So it has been the lowest in last many years. But let's talk about gas economies and how India is dependent on gas. Well, 50% of the gas consumed in India is imported and 50% is produced domestically by players like ONGC, Oil India and private players like Reliance. And if we talk about the allocation policy of the government, well, CGD companies, they get the priority in terms of getting the domestic gas, which is followed by LPG plants, fertilizer plants, power plants and steel and refinery sector. But let's talk about which sector consumes the most amount of domestic gas. Well, it is the power sector with 32% share in the overall domestic gas consumption, followed by other sectors like steel and refinery, and then we have fertilizers and then city gas distribution companies. And if we talk about the overall pie, which consists of imported as well as domestically produced gas, then it is the fertilizer sector that tops the list with 32% consumption. Now let's talk about how these sectors are really impacted. Well, for gas producers, it is going to be a big hit, right? For ONGC and Oil India, this price is below their cost of production of $3.7 per unit, and that is why this will lower their realization in coming quarters. Let's talk about the other sectors, and that is the fertilizer sector, one of the biggest consumers of gas. A 25% cut in gas prices will decline their production cost also by 12%, so it is good for their margins. But let's go across to the power segment. There it is going to be positive as well. However, gas-based plants are only 6.5% of the total capacity. And if we talk about how many plants really use gas, it's only 3 to 4% of the total power generated. However, it still is very positive for those plants. And if we talk about the city gas distribution company, usually these companies pass the decline in gas cost to the consumers in form of lower CNG prices. However, if they don't, it is going to be positive for IGL and MGL, where their EPS will increase by 20 to 25%. For Gujarat Gas, it should be up by around 13%. And not only these companies, something like a GAIL, there also EPS should go up by 5 to 6% because every $1 of decline will lead to lower LPG costs and ultimately will increase their margins. This is the kind of impact we'll see. However, there are talks that this pricing formula can be changed, and if that is done, this price could actually go up to as much as $4 to $5 per unit. And if that happens, economies will reverse, gas producers will enjoy, and gas consumers will see a hit on their margins.
Sonal, many thanks for taking us through what that price change means for the gas economy. It's time now for us to head into a break. But coming up next, October is here and it brings many changes to rules that govern your credit cards, debit cards, health insurance, LPG connections, and many more. And to find out more about all of these stories, all you need to do is log on to our website, cnbctv18.com. You'll get all the details there. We're taking a break. Back in a moment. You're watching the CNBC TV 18 Clutter Breakers. October is here and it brings a slew of changes to rules that govern credit cards, debit cards, LPG connections, health insurance, and more. Ritu joins us now to take us through what you need to do, if anything at all. Ritu.
Starting the 1st of October, several new rules or changes have come into effect, from credit and debit card rules, health insurance to motor vehicle rules that you as consumers must keep in mind. To begin with, there is a whole set of new credit and debit card rules that have now come into play. We will get into the details of this later. It requires more of an explanation. But secondly, new rules have also, which were announced in the budget to tax the digital economy, are going to kick in from the 1st of October, essentially to help establish a tax trail, especially for MSME vendors. So from now on, any e-commerce operator will have to deduct 1% tax collected at source, or TCS, on the sale of goods and services. In addition, a seller will also now be collecting 0.1% tax from the buyer if the sale value exceeds 50 lakh rupees. The third change is that any foreign remittance that is made for above 7 lakh rupees will attract a 5% tax collected at source starting 1st of October, unless TDS has already been deducted on the amount amount. Additionally, if you buy any foreign tour packages, irrespective of the amount, a 5% TCS will be applicable on that as well. Fourth, new insurance policies and rules have come into play after the advent of the COVID-19 pandemic. For instance, 17 permanent illnesses are now not going to be covered by health insurance. Insurers, that is, will also now have to make a decision on claims whether they accept or reject within 30 days. And if they fail to do so, they'll have to make a 2% additional interest payment on the dues. Fifth, you also now don't have to always worry about carrying a physical copy of your driving license and registration certificate when you're going out to drive. The Ministry of Roads, Transport and Highways has brought in new rules for commuter convenience, which allows you to drive your vehicle with just a valid soft copy of the documents. And drivers, in fact, can also maintain all the documents relating to their vehicle on the central government's online portal, such as DigiLocker. Now, sixth, if you're always wondering that the loose sweets you buy from your local sweet shop, are they fresh or not? Well, you don't have to worry anymore, because the Food Safety and Standards Authority of India has made it mandatory for sweet shop owners to declare best before date on all packaged and loose sweets that they are selling. Lastly, you'll also now be able to use your mobile phones for route navigation while you're driving without the fear of being caught by cops. But this, of course, has to be done in a manner that it does not disrupt the concentration of the driver while he's driving. Okay, so that is some of the other key rules. Let's go back to the credit and debit card rules that I referred to at the start. Now, these regulations apply to all debit and credit cards, but prepaid cards, any mass transit cards like your metro cards, those are not covered under the new guidelines. Now, all debit and credit cards that are issued or reissued from this point on will only be enabled for use at ATMs and POS terminals, etc. in India alone, which means they won't automatically be enabled for use in foreign countries when you're traveling. And if you are traveling and intend to use your credit or debit card overseas, you will have to specifically ask your bank to enable this facility. It won't be an automatic process anymore. Further, if certain credit or debit cards have never been used in India or abroad by the user for making online transactions, banks and credit card companies have been directed by RBI to immediately disable online payments for such cards to prevent any misuse. You can also manage your credit card limits to protect the damage, even if the card is stolen in the worst case scenario. For example, RBI rules say that banks must allow all users to switch on or off or change the transaction limits through their mobile banking or ATM or any other channel if they choose to do so. They can also disable the NFC technology, which is a near field technology, which you use to just wave your card in front of the machine instead of swiping or physically entering the PIN. So if you go to the Manage Cards section on your mobile banking or net banking app, you will be able to set the limits on online transactions, contactless transactions, and even international transactions. All of this to ensure that there is more security.
Well, Ritu, many thanks for helping us navigate through all of those changes. And finally this week, did you know that India's colorants industry caters to 20% of the world's demand? Dyes and pigments are the second largest subsegment of the specialty chemicals industry with huge export potential. Sonal Bhutra is back with trend spotting.
Color cuts across the boundaries of art, biology, physics, psychology, chemistry, and many other fields. Few substances are devoid of color, and most commercially marketed items are colored. So let's understand the chemistry of colors. The colorants industry has two segments, dyes and pigments, and they provide color to materials, be it textiles or paints. While a dye dissolves in liquid, pigments can be dissolved with the help of a binder. Dyes are primarily used in textiles and paper, whereas the pigments find use in paints, inks, cosmetics, and plastics. There are 12 types of dyes classified on the basis of their usage. However, reactive, disperse, and direct dyes are the most commonly used in India. Pigments are broadly classified as organic and inorganic. Let's talk about the global markets. The global dye market was valued at $10 billion in terms of revenue in 2019, and the pigment market was almost double of that at $21 billion. Global colorant market is consolidated with top 5 players accounting for more than 50% of the market share, and they are BASF, Chemours, Venator, Clariant, DIC, to name a few. Now let's talk about the Indian markets and the dye market specifically. 90% of the total dye stuff production in India is done in Gujarat, and 70% of the overall production is exported. Despite the COVID uncertainty, what is heartening is that exports are back at pre-COVID levels in August. And as per Ken Research, if we talk about the pigments market, it is valued at around 20,000 crore rupees. And the Indian dye and pigment industry, it caters to 20% of the global demand. And the companies which are majorly into the colorants market include the likes of Kiri Industries, Bodal Chemicals, Sudarshan Chemicals, Aarti Industries, Meghmani Organics, to name a few. Now let's focus on the dye value chain. The key dye raw materials are the crude derivatives, something like a naphthalene, and caustic soda and chlorine are also used. Around 15 to 20% of these raw materials are imported specifically from China. This is then used to produce dye intermediaries such as H-acid and vinyl sulfone, in which India is largely self-sufficient with only 5% imports. The prices of these two intermediaries has been stable in last 6 months. These intermediaries are further processed to make dyes. Now let's talk about the pigments market, where the raw materials is a basket of phthalic anhydride, urea and some crude derivatives. Global leader BASF sold its pigments business to DIC, and now Clariant is also looking to sell its global pigments business owing to rising raw material import prices from China and also increased competition both from Chinese and Indian players. Pigment production capacity in China is a major source for European coatings producer of organic pigments, and this has been squeezed by stricter Chinese environmental regulation. Now this provides an opportunity to Indian players to enhance their share in the global markets. While there is still a lot of uncertainty due to rising COVID cases, this segment has huge potential as it caters to a huge export market. And if the government were to offer the right inducements, it could well be one in which India can emerge a leading global supplier.
All right, Sonal, many thanks. So that's Advantage India, at least as far as the colorant business is concerned. With that, it is time for us to wrap up this edition of the CNBC TV 18 Clutter Breakers. We hope you enjoyed watching this program. We have a lot more lined up for you. As I pointed out, you can revisit each of these stories on our website, cnbctv18.com. Till next time, from all of us here on the team, goodbye. Many thanks for watching.